Welcome to this latest video in our series on trading the failure of key reversal patterns. Hello, I'm Fawad Razaqzada, market analyst with Think Markets. If you haven't already, make sure you subscribe to our YouTube channel in order to get notified when we add new video content. Now, in the previous series, we discussed key reversal patterns, but what we didn't discuss is how these reversal patterns can sometimes fail to work. While failure of reversal patterns can be frustrating, spotting and trading the failure can sometimes offer much better tradable opportunities. This is because it is likely that a large number of people would have probably seen and traded the same thing, but now that they are trapped, we can have a very good idea where the market is likely to head to. That is where the trapped traders' stop orders would be resting. So this is how a normal double top pattern may be formed. And in normal circumstances, when price breaks through the neckline of the pattern, then it will confirm the completion of the reversal formation. This could be a horizontal level, or it could be in the form of a trend line, depending on where those two lows were formed. However, if price then refuses to go down, then that is when you should pay attention to a possible failure of the double top pattern. One way to anticipate this failure is when price falls sharply to take out the neckline, rather than a slow drift towards the level. Fast moves tend to reverse just as quickly, as they can be driven by some short-term news rather than a complete U-turn in market sentiment. After the fast sell-off stalls and price shows short-term bullish characteristics below or around the neckline, and you see some evidence of sellers getting trapped, then that's when you could seriously consider fading the move. The move then starts to accelerate as the price selling turns back to buying pressure, with the sellers rushing for the exits or being forced to exit their bearish trades. Just before this happens, this is when you could be looking to trade the failure of the reversal pattern, as otherwise their reward to risk profile will no longer be favorable. Now then, the opposite of what we just discussed is the double bottom failure pattern. And here the bulls get trapped as price makes a brief higher high, typically after a fast move before the rally stalls and the downward trend resumes. So here is an example of a double top failure pattern. The cable made a double top formation right here, and the pattern was completed when the neckline was broken over here. But as you can see, there was no downside follow through, and the pound's immediate recovery was the first sign that the sellers were getting in trouble, and more confirmation came in the form of the break above this bearish trend line. Once that trend line was taken out, you can see that the cable started to creep higher, eventually pushing all the way to the top of the double top pattern, thus rendering the reversal pattern invalid. So one of the ways you could have traded this would have been to wait for the break of this bearish trend line and gone long there with a stop below the most recent low, or you could have traded the break above this consolidation zone, perhaps on the lower time frame. If you wanted further confirmation, you could have waited for the break of this high, which would have been an objective way of telling you that the trade has not worked. Here is an example of a double bottom failure pattern. The euro dollar formed this double bottom formation right here before prices surged higher to take out the neckline. It tried to break higher, but it was rejected, and price then went into a bit of consolidation before breaking down. Now the first sign that the buyers were getting into trouble came right here when the euro dollar broke below this low, which was the last low prior to the latest breakout attempt. So there was no reason for price to go back below that if the trend was still bullish. But once it went below it, any rounded retest of that level could have been sold. Your invalidation could have been a tight one above this high, or slightly wider above the most significant high here. You could have waited for further confirmation, and that came when price broke below this bullish trend line. Another area where you could have got into a short trade would have been somewhere here when price broke below this low. Any rounded retest of this level could have been sold. Now, whichever example you would have used, your target would have been the liquidity resting below these equal lows, because that's where the trapped bulls stop orders would be resting. So with your target clearly identified, it's all a question of timing the entry and knowing where to place your stop loss order.